Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Delta Airlines came out with some better than expected results for the quarter, saying that helped by leisure travelers and a rebound in corporate travel. How about that? Sid Philip joins us. He's deputy team leader for Global Aviation. Join us live here in our Bloomberg Interactive Broker Studio. Are we kind of back to pre-pandemic levels in terms of air travel?
Also, there is a dichotomy in the aviation industry at the moment where we're seeing airlines' profitability, especially at the top end of the market in the premium and corporate sector, they're doing really well. So Delta Airlines, United Airlines doing really well. At the other end of the market, there's the likes of Spirit Airlines that's in its second bankruptcy. Oof. You've got the other sort of low-cost carriers that are struggling to fill up seats. And that's partly on account of the fact that low-cost carriers, their customer base is still hurting from the sort of tariffs and the economic uncertainty. Whereas for the top end of the market, they seem to be traveling as normal, actually.
Yeah, it's the manifestation of the K-shaped economy, right? Where the higher income consumer is doing much better than the lower end consumer. The CEO of Delta, Ed Bastian, said in the earnings report that our customer is financially in a good spot. Sid, who exactly is Delta's customer? Because it's not the same, as you said, as, for instance, Spirit or Southwest, or even, you can argue, United.
Sure. I mean, Delta Airlines, they frequently talk about how their customer is in the sort of average of over 100,000 earnings, in $100,000 a year in terms of earnings, and they sort of are looking for experiences. They're looking to sort of travel premium. They're not looking to sort of go coach and sort of nickel and dime their way through the aviation experience, and they're sort of more willing to splurge on experiences, and that's sort of the post-pandemic revenge traveler who is now continuing to sort of spend money on travel. And they seem to be suggesting that people are willing to keep going and keep traveling and keep spending money on experiences and holidays.
Well, if United beats their numbers this quarter, it's because of what I spent to get over to Italy. Spared no expense to get over there. I needed the rest. Talk to us about just visibility. These airlines, do they have some pretty decent visibility on their bookings?
So they do. They've been talking about how their visibility into the holiday quarter, into the fourth quarter of the year, is looking good at the moment. They're seeing demand being strong as they get into the close of the year, and that's at least Delta Airlines is talking about how they expect corporate travel to continue to be so solid and robust in 2026. They're saying that companies that they surveyed are seeing continued appetite for corporate travel. So it remains to be seen what actually materializes. Airlines had massive forecasts for record growth this year, and then sort of Liberation Day came around and that sort of torpedoed that, and they've now sort of come back to those levels, but remains to be seen what surprises come out next year.
I'm so glad you bring that up, because earlier this year, Delta warned of an abrupt slowdown, or I don't know that it actually saw one. It just said it was seeing it on the horizon. Has that been completely erased and turned around now?
For the moment, it does look like it is smoother skies for them. But at the same time, we don't really know what's going to happen in the current economic environment or what demand looks like as we go into 2026. And that's something that we need to watch as the airlines sort of report their fourth quarter results and sort of talk about their future forecasts.
What are the big airlines, the big ones you mentioned, United, Deltas, what are they doing with capacity? Are they adding capacity, trimming it back? I don't know what they're doing with routes. I don't know if they have enough planes, all that kind of stuff.
So they have been, Delta's been adding capacity. They've been retiring older planes and taking on new planes. And so they seem to be adding a little bit of capacity. And we're also seeing, United talk about how they are upgrading their fleet. They're replacing their older aircraft with 787s and MAXs. And so we are seeing the US carriers upgrade their fleets, and that's sort of adding more capacity, especially as they upgauge aircraft. So they sort of replace smaller narrow bodies with the larger A321 or the MAX 9, and that sort of adds more seats and more capacity. But then at the same time, they're also premiumizing the cabins. So they're adding more business class cabins and more premium economy than they ever did before.
Premiumizing. That is a new word. I had not heard of it, but it makes a lot of sense.
The premium economy coming back from Italy was actually like the old first class in terms of
really
room. I was shocked at how much room there was in this.
How far back can you recline?
Just the normal one.
Okay,
but it was just way more legroom. And it wasn't that much money. It was like a couple $100 to upgrade from it. So that was pretty interesting.
And that's a big part of Delta's push, right? Pushing these premium products in the cabin. What about on the ground? What is Delta doing on the ground to really harness its customers' desire for a premium experience?
So they're sort of partnering with they have that partnership with Uber. They've sort of added more of those Delta One lounges, and they're sort of doing those credit card partnerships. And those are all sort of ways to keep customers sticky and keep them engaged, because the moment you're sort of signed into the ecosystem, you're more likely to book with them and sort of not really use price comparison websites. You're more likely to sort of keep going.
Customer for life kind of thing.
Yeah. Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
I'm a Coke guy, but you can put with Pepsi in front of me. I'm fine. I'm just as happy. I can care less. But Ken Shea, he follows this stuff for a living. Ken Shea is a senior consumer products analyst for Bloomberg Intelligence. Pepsi reported some numbers a little bit better than expected here. Ken, tell us what you heard from our good friends at Pepsi.
Yeah, hi, Paul. Well, PepsiCo reported a numbers today that were pretty much in line, maybe a little bit above expectations, but I think they also masked persistent weak market conditions in the U.S. Across its broad food, snack, and beverage businesses. The company pretty much hit their numbers, as I said, but it didn't do much to relieve the pressure it's getting from an activist who's asking the company to do more. Basically, flat performance is just not good enough for something that's perceived, or a company that's perceived as a growth company. I guess the good news is their language during the call, though, did provide investors a bit of optimism. It sounds like the company is getting it. They said they're going to ramp up innovation. They're going to be more aggressive with cost cutting. They're listening to the activist points, and they said, by and large, they agree with many of them. So those are all good things to hear, from an investor point of view. It's just a matter of executing and actually following through with them, I think, is where the jury is out.
So I guess, Ken, the question is this enough for Elliott, the activist investor, which took about a $4 billion stake in PepsiCo and called for a strategic review, a streamlining of the snack portfolio in particular?
Well, I think the CEO of PepsiCo mentioned that they are on the same page on a lot of fronts. But what they didn't say is one of the big things that Elliott is calling for is basically, the beverage business to refranchise itself, sort of what Coca-Cola does, to let the bottlers be independent rather than own those very capital-intensive businesses. They didn't go there. I'm sure that's going to be a big sticky point. What they are in agreement, though, is that innovation is needed to be even more on trend. I covered PepsiCo. I've covered PepsiCo for a long time. They are probably on the forefront of the most innovative companies across the beverage world that I cover. And yet they're even ramping it up even more aggressively across food, aggressively across beverage to be as on trend as possible. And on that note, Bloomberg Intelligence came out with its annual consumer beverage survey just on Monday. And some of the big findings that we're seeing is that advanced hydration, wellness, and value are more important than ever in the world of beverages. And it was interesting to hear PepsiCo pretty much address all three of those areas with their new product innovation. So that's encouraging.
At the end of the day, Ken, is a company like Pepsi, is that nothing more than really a GDP kind of growth story? There's not much more you can do to goose it above that? Or can they do better maybe?
That may be true in the U.S., Paul. I mean, it's such a large business. It's in most channels. It's been around a long time, obviously. But I think most people looking at this company would say, look, you have great opportunities outside the U.S. There's much less price competition. outside the U.S. People are embracing, these consumer goods and these brands outside the U.S. So that's one of the things Elliott is actually saying, provide, feed the capital needed outside the U.S. to grow these businesses in these big growing markets, like China and India and so on, Latin America. These are really big growing markets. And to the extent that they could play more in those markets, I think would be good for the enterprise in the whole.
But for those markets, would they need to take a similar approach as what they do in the U.S., be more innovative, keep up with this shifting consumer taste towards healthier offerings, higher protein, portion controlled, less sugary drinks? Or can they go with their old playbook?
I think it's a combination of doing what they're doing. In some of these markets, they have to adhere to local tastes. My guess is that a lot of these consumers are seeking the same kind of things the U.S. though is, or I should say, wellness value. But the portfolios are not quite as broad outside the U.S. So I think it's tailoring towards the local areas and bringing some of their learnings from the U.S. to these markets over time.
Ken, talk to us about they got about a 4% dividend yield on Pepsi. That seems pretty solid. What's their policy on dividends these days?
Oh, they're committed. I mean, they know that a big shareholder base, is income investors. So they're committed. And every quarter, like this one, they said, look, we're committed to have a multi-pronged capital allocation policy. We're going to, invest in the business, innovation, like I said. But they're also going to buy stock back on a, selective basis. They're going to commit to their growing dividend. And their balance sheet would support them doing that. I mean, the balance sheet is in good shape. It's in good investment grade. And so I see this company continuing to have a balanced allocation going forward.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We were talking about the auto business and Ferrari. Ferrari's sinking. This brings to mind, I don't know how these companies are going to go for the next 5 years, 10 years in terms of that evolution, because it's kind of fits and starts. And
they can't figure out next year.
At some point, the market rewards them for it. At some point, the market penalizes them for it. Craig Trudell, it's his job to make sense out of all this. He's a Global Autos Editor for Bloomberg News. So, Craig, when you see news from Ferrari about its cautious forecast, maybe just kind of some cautious commentary on EVs, what does that tell you here from Ferrari?
Yeah, I mean, I think the market was taking in stride, the caution on EVs. I think even, sort of among the investor base and certainly the analysts too, there's some real concerns about, just how sort of incongruous EVs are with Ferrari, and some questions about whether they should even bother going in that direction. I think the shares were down a little bit, earlier this morning when they were talking about that. I think where we saw the stock really just take it on the chin was when they came out with their outlook, for through 2030. And I think that the profit, growth was underwhelming. I should, sort of say it also is the case that they are still, calling for growth. I think some analysts were maybe hoping for also some increase in volumes, but that's not really, what Ferrari is about. They, are sort of like clockwork, making a pretty set number of vehicles every year, and charging an awful lot of money for them, and that's really been something that's paid off. And I think just the other thing to sort of keep in mind here when you look at what these shares have done, since they listed. The shares in Milan have been trading since early 2016. The New York ones a little bit earlier than that, but this is a stock that has absolutely been on a tear all those years since. And so, yes, a 16% decline in one day, sort of makes your eyes pop. But this is a company that is still valued very richly, and that makes a little bit more sense in hindsight.
And Ferrari also, of course, coming out with its first EV too, and that might be accounting for some of the caution in terms of what it sees going forward. In the story, you and your colleagues, Craig, talk about how not just Ferrari, but Porsche and Mercedes-Benz have also struggled with the electric transition. Why are wealthy buyers somewhat resistant to switching over to plug-in EVs? What's behind that?
Yeah, it's a really good question. I think, there was just this sort of working assumption that, the only thing that you were going to have to overcome was cost. And so, there was this, I think, sort of conventional wisdom. Well, we'll just have, the folks who are sort of most able to afford this incremental additional costs, they'll foot the bill, and we'll be sort of off and running as an industry and gradually sort of work our way down price wise. I think if you're a luxury car buyer and you're having to pay a significant premium over, looking at models that are the same, one combustion and one electric, the electric one's a lot more. It is still a decision, and sort of a rational decision to sort of second guess whether or not you want to go electric. And I think that's what you're seeing is that BMW and Mercedes, until and unless they sort of price their models closer to one another, you're going to have some pushback on the part of the consumer to make that transition, even as we make progress in things like charging infrastructure and some of these hurdles that you have to overcome that are unique to EVs.
My biggest question for the supercars going electric is, I think a big part of the reason people buy the Ferraris, the Lamborghinis, is for the cool sound when they're coming down the street. What's Ferrari doing with that part of it?
Yeah, it's interesting, and we saw it sort of we had indications that Ferrari was working on something in this regard to try and sort of preserve the noise that you can make driving a Ferrari, that they patented systems to kind of create essentially artificial noise, or at least to play up the noise that is made by electric motors in electric vehicles. I think, that being said, will we see Ferraris externally make nearly as much noise as a Ferrari supercar? I suspect that the answer to that is probably no. But I've been very entertained that Dodge came out with an electric vehicle last year, and I saw a report recently that an owner in Canada was ticketed for a noise violation with his electric Dodge vehicle. So maybe it's for the best, actually, that this will become a thing of the past.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's talk a little bit about the media business there. It's undergoing a certain degree of consolidation here as it tries to deal with the rising tide of YouTube, among other streaming type services and digital services that have really displaced many of the traditional media businesses. And one of those is Paramount Global. That was bought by Skydance, Larry Ellison's family. Now looking to take a look at Warner Brothers Discovery, another publicly traded company. Maybe those two might get together. Let's check in with Geetha Ranganathan. She's the media analyst over at Bloomberg Intelligence. Geetha, talk to us about the likelihood of Paramount merging with or acquiring Warner Brothers Discovery, and how that might look.
Yeah, thank you so much, Paul. So it's been a while, actually. So there's been these on again, off again reports. The first time the news broke was almost a month ago. It was on September 11th that there was this Wall Street Journal article which suggested that Paramount was kind of exploring this bid. There hasn't actually been any formal bid from Paramount. However, the shares of both those companies have kind of really gone up very nicely on the news, kind of just telling us how important it is for both of them to have this consolidation. If you look at Paramount, obviously they just went through that merger. There is really very little details when it comes to what is, kind of the strategy for this business. They definitely need something big. Having a studio like Warner, having a service like HBO Max, it really kind of puts them on that global media map. So I think they definitely need it in order to kind of make this big splash in the media ecosystem. But they're, as days pass along and we don't get a bid, it just seems like the probability of this happening gets smaller and smaller.
Yeah, it's curious because we've been waiting for so long and the industry has been ripe for consolidation. And David Zaslav, who of course runs Warner Brothers Discovery, has been talking about how consolidation is something that he anticipates and he wants to see happen. Is there a role here for regulators? Is this something that they would weigh in on? Is Brendan Carr going to play any kind of role here?
So Paramount, yes, there is potentially a role for any and all types of regulatory scrutiny. In the Paramount Warner Brothers deal or a potential deal, the FCC's involvement likely wouldn't be as heavy just because there is no merger of two broadcast assets. So Warner Brothers only has streaming, studio, and cable networks, no broadcast networks, like Paramount, which owns the CBS broadcast network. So they should get like a fairly, quick green signal from the FCC. Well, all mergers are ultimately, kind of a subject to regulatory scrutiny. But let's remember, Paramount has just gone through this whole process with the regulators, kind of getting that Skydance. So they kind of know how to navigate their whole way around, the regulatory ecosystem, if you will. So I don't think it should be much of a problem at all, Scarlet.
Now, the New York Post, I saw some reporting. And by the way, the New York Post, they do a great job covering the media sector, particularly on the M&A front. Always have. They're suggesting maybe Paramount Skydance might be talking with some private equity players about participating in any potential deal. And I think they mentioned Apollo as one that they were talking with. What does that mean to you?
What that means to us is that, obviously funding is a problem here. I mean, this is a big deal, Paul. There was an initial a price range that was suggested by CNBC of about $22 to $24 a share. I think David Zaslav is looking for something much, much higher than that. The New York Post themselves had reported that he was probably looking for something in the range of $40 a share.
Oh boy,
not sure whether he's
spread.
going to, not sure whether he's going to get that. But regardless, I mean, this is a huge deal. I mean, even at that $22, $24, we're looking at about a $60 billion deal. So funding is definitely going to be, an issue. And that's kind of what it suggests, the news article from yesterday suggests to us, because if Paramount is kind of scouting for all of these different partners, they've talked to Apollo, as you just suggested, they're talking to Legendary, funding doesn't seem to be as easy as, maybe we initially thought.
And also Warner Brothers is carrying a lot of debt. I know Zaslav has made a priority of reducing leverage, and he has executed on a lot of that, but there is still quite a bit of debt involved here. How willing is Skydance to take that on?
They are willing to take that on because, Scarlet, Warner Brothers is actually in the midst of their own restructuring. So what they had planned, even before all of this Paramount news broke, they had planned to actually split their company. So they have a TV networks business and they have their streaming and studio business. So kind of the no growth assets and the high growth assets, they're kind of splitting those two out. And majority of the debt, they started with about $55 billion in debt. They've kind of whittled that down to about $32 billion. But majority of that $32 billion debt was actually supposed to travel with the TV networks business. With Paramount kind of coming in and making a bid for the entire company, even before that split actually took place, just kind of signaled that they wanted to get the entire business, and they were willing to take all of the debt, not wait for the split and wait for kind of the debt to go away and then just go scoop in on the streaming assets. So they definitely know about the situation and seemed like they were willing to take it.
Another company that's announced they're splitting their networks away was Comcast. Where are we on that?
So that seems to be coming pretty close. Now, in contrast to the whole Warner Brothers Discovery split, the nice thing about the Comcast cable network split, which is, by the way, going to be called Versant, is that it doesn't have a lot of debt. So it's really a well-capitalized company. They're throwing off about $3 billion in EBITDA, but debt is only going to be close to about $2.5 to $3 billion. So really well capitalized. The problem is with the cable network business, as you well know, Paul, that just the options are not looking that great. Affiliate revenue, as we know, is in decline with cord cutting. Again, advertising is going to be, that most of these ad dollars are going away from linear TV to digital outlets. So again, the outlook is just very bleak. But that company should come on the market sometime pretty soon.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube. and always on the Bloomberg Terminal.